I think we're
Hello,
live.
everyone. We are live. How's everyone doing today? Um, Maybe we'll give it a few seconds or minutes, let a few people join in. Maybe in the meantime, we can do some quick intros.
Yeah, definitely. Let's do it. Faisal, awesome to be here with you today. Oh, people are rushing through the doors now. Um, but thanks everybody for taking the time to join us, this evening. My name is Akshay Iyer. I'm one of the wealth advisors on the team here at Sarwa. Super excited for our session today. Joined by my colleague Faisal Abdul Shakur. Faisal, maybe I'll pass it over to you just so you can get everybody acquainted. But yeah, I'm very excited for this webinar today.
Thank you, Akshay. As Akshay mentioned, my name is Faisal Abdul also part of the advisory team at Sarwa. I'm honestly really excited for this one and to be here with you all today. Because today we're talking about data and to how we're essentially taking a data-driven look at how Sarwa clients have been investing. The time frame that we're focusing on today is the first half of 2025. So that's from January 1st to June 30th. And while we've looked at, behaviors and data across both trade and invest, the majority of today's insights will center on Sarwa trade clients. So we'll be walking through some interesting trends and behaviors from the first half of 2025. And I must admit, I'm a bit of a data nerd, and Akshay can attest to that.
I can definitely
Uh,
attest to that. Yes.
uh, but before we get into the fun stuff and the juicy stuff, we have to get a few essential disclaimers out of the way. Um, so, as you know, neither Akshay or myself can predict the future. We don't know what's going to happen the next few weeks or the next few months. Our views should not be interpreted as one-on-one advice. Please do your due diligence when it comes to any type of investment. As you know, all investments carry risk. Specific to this session, the data that we present is informational only. So we've done our best to share useful insights, but the charts and figures presented here are for information purposes only. And again, the data is focusing on the first half of 2025. And keeping in line with the theme of this webinar, we wanted to essentially um, pull live data today from you guys here today and start off with a poll. So actually want to kick us off?
Yeah, definitely. Let's do it. So, and even before we kind of go into the poll, so some context about, obviously what we're doing today. The real purpose of this is to dive a bit deeper, right? Our clients have been around for a while, and I think a lot of them have always been interested. I've gotten the question a lot. In fact, I'm sure you have. The rest of our team gets it. How do your investors perform? How do they perform compared to benchmarks? And I think in the spirit of transparency, we now, realize that it's really important to share this information with our client base, to provide insights, to provide behavioral insights also, and really just get an idea of what your peers are doing, and where can you learn, from them. But we framed this whole webinar. I remember when we were doing our ideation, it was like, look, how do we think our Sarwa investors compared to the S&P 500 year to date? And so we want to start with this thought exercise, right? So as Faisal said, we're going to be launching a poll. So consider all the Sarwa trade clients, right? Think about, yourself and all the other peers that you have. And between January 1st and June 30th, ask yourself this, right? What percentage of these clients, in your guess, outperformed the S&P 500 during that 6-month period? So, option A, underperformed. Option B, performed roughly around the same. And option C, outperformed the S&P 500. So I'm going to give it, a couple of, maybe we'll give it like maybe 30 seconds to a minute. But everybody, please fill in this poll because I'd be very curious to see, what people think about this. And I'm not going to say anything. I don't want to skew anything. So just going to wait for all of the information to come in.
Good participation so far. We're at almost full participation.
Oh, okay. So, oh yeah, we can see the particip. Okay, everyone. I think there's still some people who haven't participated. So we're gonna urge you to to click which one you think it might be.
We want the data to be as accurate as possible.
Interesting. And I know, Faisal, when we were, usually when you kind of look at these things, right? This is a big question. The S&P 500 is the benchmark that most people use. when they compare
Yeah,
their own investments to it. More often than not, even if you're in a European, equity fund, or even if you're investing in, I don't know, cryptocurrencies, whatever it might be, people use the S&P 500 as a benchmark.
yeah,
Yeah, right. It tends to be the compass.
true, true. And also you'll see throughout this webinar, we will kind of refer back to the SP 500 often. So yeah, it is kind of the standard that you people usually assess against.
Nice. Okay, should we call it that? I think, oh, actually some people are still responding. So if anybody else hasn't responded, we're gonna close the poll in a couple of seconds. So feel free to throw in your response. Oh, still some more.
Surprising responses.
Yeah, I know. I think this is not what I was expecting.
Yeah, I thought it'd be the opposite.
Okay, shall we end the poll?
All right, closing the poll. And we'll share the results.
Okay, so what can we see from the poll? So 13% said that Sarwa trade users underperformed the S&P 500. 50% of the poll said that they performed about the same, and 38% have said that Sarwa trade users outperformed the S&P 500. So I think usually when, I think the expectation that I had is that most people would choose A or B. And I
Yeah,
think in this case, most people have chosen B or C. And the reason why I say that is because the broad narrative tends to be that retail investors rarely beat the market, right? I'm sure you've heard it time and time again. But what does the actual data show? Let's dive into that. So here's the reveal. From Jan 1st to June 30th, 2025, the S&P 500 delivered approximately 7% in total returns. But when we look at the complete set of Sarwa trade clients, we find that the year to date return is 9%. And that goes against typical expectations, right? Very important for everybody to know that. And I think this is super meaningful because this is unfiltered data. This includes cautious investors, hobbyist investors, newcomers, super experienced investors, everybody. We didn't filter to say, hey, like this is the top investors or anything like that. This is the broad-based investment, uh, you know, client base that we have. Yet the average outcome actually surpassed the index. It reflects real behavior, right? Not theoretical optimizations, but actual real decisions that people have made in real time. And think about investors that are actually taking investment decisions, right? Some take them in cautious environments, volatile sectors, and we're going to dive a bit deeper into how this actually happened, into the data, the behavior. But to give you a sneak peek, two behavioral patterns that really stood out, Faisal, that I'm sure everybody will be interested in, was the first thing was sector conviction. A lot of our clients that we saw built early positions in high growth sectors, things like AI, healthcare innovation, semiconductors. They weren't buying the noise. They were investing in actual underlying fundamentals before the sort of rallies that took off. And the second thing, super important, emotional composure. They didn't panic at market flips. They understood that the pullbacks are part of the process. Instead of selling when headlines were dire, they remained invested. I think it subverts. I'm sure, Faisal, you've heard of the term dumb money. I don't know if anybody else in the audience has heard of the term dumb money stereotype. That a lot of institutions think of retail investors, it suggests that behavior trumps background. And you don't need an institutional playbook. Often more than not, you need discipline, patience, and an intention. So the results speak for themselves. But I'm going to pass it to you now, just to actually give everybody an understanding of what were people holding.
yeah, thanks actually. And before I get into this, just a reminder, you can leave your questions in the Q&A. We'll get to them towards the end. But yeah, good segue actually. So now here we're looking at essentially in H1, first half of 2025, what were the most traded assets? So here they're ranked by most traded. And of course, no surprises actually mentioned. We have a lot of, you know, clients tilted or leaning towards tech with names like Apple, Nvidia, Tesla, which are consistently among the most commonly held individual stocks. But we also have, interestingly, ETFs, or specifically the VOO ETF, which covers the S&P 500. Crypto made a presence, specifically Bitcoin and Ethereum. While it makes up a smaller portion, as you can see, in terms of trading volume, equities accounted for roughly 90% of trading volume in this period, whereas crypto made up 10%. Now, just a caveat on equities, this includes ETFs as well. It includes commodities, it includes REITs. So it's a pretty large blanket term, but nonetheless, it surpassed crypto tenfold. Um, and Altogether, the top holdings, I would say, reflect a growth-focused mindset, with a clear preference for mega cap names, broad equity exposure, and in some cases, like we just saw, alternative assets like crypto, which takes us to how did these assets, how were they traded, right? So how did Sarwa clients actually trade these top assets? And
Yeah,
when going to the, actually, please.
no, no, sorry. And I no, I was just gonna say that, when we look at these top 10 traded assets, right? 1 to 10, this is, let's assume you're making a portfolio out of these 10 securities. This is a very tech-heavy, growth-orientated
Yeah,
portfolio.
yeah,
Um, but what's also quite interesting, it is quite well diversified if you think about it from a asset class perspective. We've got in out of those 10, we've got an ETF in there, VO, which represents a broad-based market approach. We've got individual stocks that are definitely tech heavy. We've got gold, which acts as an inflation hedge, and we've got some cryptocurrencies in there. I was quite surprised to see this. I'll be honest, I assumed just by default it would be purely tech stocks. I wasn't necessarily
yeah.
going to expect to see gold in there. It makes sense, but after what obviously the rally that we've had. But this kind of represents an interesting portfolio for maybe some inspiration, and then also for some investors who have these high
Absolutely.
conviction picks, right?
Absolutely. And you're right to call out gold. Gold is, I think, stood out the most to me. And we have a section later on that dives into gold. But yeah, it is pretty diverse, pretty broad. Not 100% what I was expecting, but interesting find nonetheless. So going into how these assets were traded, right? So we're looking here, same period, first half of 2025. And on average, each client within Settle Trade made around 28 trades over the 6-month period, roughly 7 trades per month per client. So this level of activity really suggests more of an active hands-on approach, with many clients responding to these market conditions in real time. And when we analyzed holding periods, so the column you see next to the top held assets, this is showing us average holding periods for these top held assets. And at the high end, at the top end, you have VOO, right? Again, this is an ETF that tracks S&P 500, and it was held for an average of 82 days, which kind of aligns with the long-term investing, approach that investors usually take when investing in an ETF. And interestingly, 85% of those that bought VOO within this period still had open positions at the end of June. So really a small percentage of investors sold their VOO holdings in this time, which shows, again, a strong sign of conviction in passive strategies. On the other end of the spectrum, we've got Tesla, and Tesla had an average holding period within this same time frame of 49 days, and only 37% of traders remained open by the end of this period, which suggests more of a tactical, maybe profit-taking kind of, or even reactive selling when we saw some volatility in April. Um, Crypto was kind of told us a different story here. So despite its reputation for volatility, Bitcoin, Ethereum were held for more than 70 days on average. Around 63 to 64% of crypto trades remained open, which suggests some clients saw crypto as part of a long-term strategy rather than a quick kind of active play. Gold, often seen as a stable hedge, showed shorter holding periods, around 51 days. That may have reflected the tactical play or a short-term hedge, particularly during the volatility. And again, to put this into perspective, I quickly looked up what is the average holding period in the US for US equities. And keep in mind, I'm about to reference a study that was done by Reuters based on New York Stock Exchange data. And they had found that the average holding period for assets was 5.5, so 5.5 months as of June, which was down from 8.5 months as of end of 2019. Granted, they have a larger sample size. We focused just on the top 10 traded assets during the first half of 2025. But nonetheless, it was an interesting reference point. And I was also curious what the average holding period for top stocks or stocks in general was. Um, which is a result, and the study goes to say that because of lower trading fees and convenience and ease of access, which ultimately keeps bringing down this average as time goes by. And I remember in 1950s, the average holding period was 8 or 7 years, which is a huge drop. But ultimately, the way investors buy and hold, their average holding period will boil down to your own particular goals, your specific risks tolerance, and your conviction. So we saw examples of all three scenarios across the data. So it really is, painting or has a mix kind of a mixed bag in terms of why clients sold during this time.
Yeah, super interesting. Um, but so we've talked about like obviously what they held, what they've traded, and how they've traded. But I also want to move on to a section about contributions, deposits, right? It's something that's often overlooked, but a very crucial part about building wealth. So this chart, right? This represents the year-to-date data that we have from Jan 1st to June 30th with the S&P 500 uh, points on the left of the chart and the dates on the bottom, right? So the yellow on this chart over here is the S&P 500. The dashed line is Sarwa deposits. And here's what the data shows, right? During periods when volatility spiked, whether it was from macro headlines, geopolitical uncertainty, regulatory announcements, whatever it might have been, we saw that deposits and deposit volume among trade clients actually increased significantly, right? Let's take a look over here, right? In bang in the middle where you see the surge of deposits, that was end of March, early April. Now, what ends up happening, right? When you look at why markets are falling and tend to fall more significantly over time, it's to do with sell-offs, right? Most retail investors sell or stop investing. They watch from the sidelines. They wait for clarity. But these investors, our Sarwa trade clients, were doing something different. They were deploying. And so consider what that does when you're deploying capital during volatile times, but also during dips, right? During dips, you're buying more shares per dollar. Equity accumulates when valuations are cheaper. Really as simple as that. I'm sure a lot of you might have heard of the phrase of dollar cost averaging. It's kind of like dollar cost averaging, but with a bit of conviction as well. Um, I remember having conversations with clients around this time where two very distinct ones, right? You've got one investor who stops investing during volatility, and I think this is more historic. But more often than not, when we're having conversations with clients during that time, investors were very understanding of what was going on in the markets. They just kept plugging in or even doubling down. Over 6 months, even modest deposits, make a difference in that accumulation. In longer times, it obviously is more significant, right? Disciplined investors are sort of growing, right? It's not necessarily a fluke or anything. It's not a rule-based strategy. It was emotional steadiness, right? Emotion ultimately drives those outcomes. And I think the belief in investing through uncertainty and not around it is actually probably proved to be an advantage to clients. So interesting where clients actually double down, during these times of volatility. And, looking back, right, as exactly what those behaviors were and to dive deeper into exactly what was going on in April of 2025, it was a super important moment for the markets. I think April 2nd, there was a new set of tariffs. It was this, big liberation day, that the US president had announced. This sent ripple effects through global markets. Tech supply chains wavered. There's like a big risk sentiment dropped. On April 3rd, the S&P slipped roughly 6% from highs, in one day. US equity volatility obviously surged. There was more geopolitical friction, in Eastern Europe and the Middle East, and then that compounded investor anxiety already. So it felt like, there was a full global correction, right? Equities across Europe, Asia, the US dropped very shortly after. Bonds spiked, gold rallied. A lot of people looked at it as a safe haven, a bit of a store of value. Crypto also saw a very sharp correction. So everything was looking pretty volatile. And during this time, that I've just described, right? So I've set the picture of what was happening, right? I want everybody on the call to write into the chat what you think might have been the most traded stock or the most traded asset during this April volatility cycle. So if you can please, on the chat function, please put that into the chat what you think might have been the most traded asset during April of 2025. And we're gonna, actually show what that was. But that's what happened in April. You see on the chart over here, very shortly after, a couple weeks after, something changed by late April. The US market completely retracted all of the losses, moved to new highs. European markets bounced back, and not just bounced back, they bounced back well, right? Posting 9 to 13% total returns for H1. When you look at, the FTSE and other key European indicators, gold stabilized and rallied, bond yields retracted. So things changed, right? We had a very sharp period of volatility, but what did our clients do in that time period? So I think we've got some comments about what assets were held. So somebody has said gold. So I'm gonna pass it over, Faisal, to you to just actually show exactly what people think or what the actual data shows.
Yes, not too far, Mohammed. Gold definitely made the list for sure. And again, here we're honing in on the volatile period, right? So April. And as I actually mentioned, really the pattern we saw amongst our clients is that they leaned into the volatility, right? Showing a preference for buying rather than selling. In fact, there were more buys during this period than there were selling, especially for the same asset. So except maybe for Nvidia was number one on most bought, but also number one on most sold. This is essentially a clear indication that our clients did lean into that volatility, didn't shy away, didn't scare away from the volatility. And if we take a closer look, again, Nvidia tops the list, which is not a surprise given its strong performance and its role in AI. VOO is honestly a bit of a surprise to myself. Typically, I wouldn't have thought a diversified portfolio ETF would have made the lists, but showed that some investors stuck to diversified exposure during this volatile time. Tech companies, dominated this list as well. Amazon, Apple, Microsoft, Meta, and Google. Similarly, on the sell side, we have, tech companies, which suggests some investors might have in April decided to either take profits, rebalance, or de-risk their portfolios, which is an interesting, I would say, list. I thought I'd see completely different assets there. But to be honest, and Mohammed, this goes to your comment, the most two surprising elements here for me were Bitcoin and gold. Starting with Bitcoin. So Bitcoin during this period reached its lowest point in the year in April. So it reached around 75K in April. And we saw a huge spike in buying activity, right? So people capitalized on that downturn. And it was almost one of the most sold assets as well. So around 63% of those that invested in Bitcoin had still open positions by the end of June. So it shows that Bitcoin wasn't just a speculative trade, really. It was seen as part of a broader strategy, maybe even a non-traditional hedge. And gold, and just to clarify here, gold is essentially tracking one of the gold ETFs, GLD, which is among other gold ETFs on the platform. But specifically here, we're shining the light on GLD. So it hit gold, as you all might know, gold hit an all-time high in April. It reached $3,500 per ounce. And we saw within our data that there was a significant increase in both buys as well as sells. So that dual behavior, the buying part wasn't a surprise to me, but the fact that a lot of people sold their gold positions might have suggested that people, were kind of taking their gains while others were parking it or using it as a hedge. But it's really interesting. And similarly to gold's, significant all-time rise, we too saw an uptake in our trading activity when it comes to gold. So zooming in on gold, the next section actually will show us how gold, as gold reached its all-time high in April, So too were the number of Sarwa trade clients that were also have gained exposure to gold. So from March to April, there was an increase from 8% to 13%, meaning of all Sarwa trade clients, 13% actually bought a GLD, which is a quite a big jump from our records. And when we were looking at volume, trading volume specifically, we saw an increase of around 174% in trading volume, in trading value, from month on month, right? So from March to April, the value in which gold was traded, specifically GLD, increased 174%, which was already up from February to March by 93%. So we've been seeing significant rises in gold, which correlate to the overall, market sentiment and as well as gold reaching an all-time high. Um, and while we can't speak on the individual motivations, but what the data suggests is that many clients were paying close attention to gold during this period, right? Some used it as a safe haven amongst the volatility, while others kind of took advantage of that price spike and capitalized on it as well, or realigned their portfolios in lieu of that. Either way, gold clearly became a more active part of portfolios and decision making in April, whether as a hedge, a tactical play, or both.
Yeah, it's super interesting, right? Because I think historically, you don't really, a lot of people who have gold as a part of their portfolio, you don't really think of it as, a very active or growth oriented to play. It's more stable, as you mentioned, meant to be sort of a safe haven. And it makes sense, right? This year, during that time, we've obviously experienced geopolitical issues. The overall stock market was extremely volatile. So a lot of people would go to gold at that point in time. That makes sense. But if you told me, if we were having this conversation on January 1st and you said that gold was going to be up halfway through the
Yeah,
year, 25%, I would not have believed you.
yeah,
More than crypto, I think, right? Or maybe not right now with the way that Bitcoin has performed, but relatively similar potentially, which is crazy
yeah,
to say
definitely.
the least. But yeah, it's super interesting to see where, obviously where the gold market has gone to, and then also that the clients and our users were actually doubling down, on
Right.
this. And as you said, right, some used it as an opportunity for stability, but I think a lot of people also use it as an opportunity for growth, which is very interesting to see. Perfect. So I think we've talked a lot about where investors have done quite well and what they've been doing and some of the gains. But to also, we also wanted, for this to be a learning opportunity and experience because not necessarily everyone on the call is going to have done exactly what, what everybody else was doing. And we do have some information, from what some of our clients did. And not everybody navigated, the first half of the year that well. And even within Sarwa trade, we saw, I'd say, four clear behavioral patterns that actually undercut returns. So the first one was exiting too fast or panic selling during downturns, right? The April dip, it actually sparked a lot of panic in some investors, not as many, right? Because we clearly saw deposits and trading volume increased, but we did have clients who sold into a decline, right? By selling, they locked in losses and didn't benefit, right, by the 2, 3 week rebound. If those clients would have held, still they would have been in a pretty solid position if we're, as of today. Another thing, pausing contributions. I think when markets dip, instinct is to wait, but a lot of clients who froze deposits lost out on low entry points. Share accumulation, it wasn't as effective and it was more the wrong moment. I'm not saying this is not necessarily for clients who are looking for opportune moments. There's a lot of clients who, like clockwork, they allocate a certain amount of
Mm.
their funds towards certain stocks or ETFs or even the Sarwa Invest Globally Diversified Portfolios. When markets take a dive and those ones who pause contributions, they were kicking themselves in the foot because they, didn't get to take advantage of that lower price point. So pausing
Yeah,
contributions, stopping contributions, that was, another one of these behavioral patterns. The third thing was overconcentration or chasing short-term trends, right? Some portfolios were heavily weighted towards very speculative names, whether it's single biotech stocks or emerging thematic plays. And I think when those failed, they tended to pull the entire portfolio down. And this is not necessarily a behavioral point, but it kind of lends a little bit more to portfolio construction overall, where once again emphasizing the importance of diversification. Because think about it as, put yourself in the shoes of somebody who's maybe put, their full trading net worth into one or two individual stocks. What ends up happening if those stocks take a dive, it's a lot more difficult to recover from it mentally, emotionally, and all of that stuff. So over concentration tended to hurt performance. But if people just waited it out, then you're probably in a good spot later. Um, and then, the last one, over concentration into speculative themes, right? So a little bit about chasing momentum, right? Piling into crypto after March or AI in late spring. And this often coincided with fleeting peaks, right? People would exit prematurely, and they weren't wrong for caring about volatility, but wrong about the timing. I think reaction gets rewarded less than reflection, right? So
Mm.
important to always consider, what you're doing with the markets and the reason why you're doing it. When you're executing trades now. And we've often found that when people have clarity, when they have a clear investment approach or investment strategy, rules, parameters, these sorts of things, they tend to perform the best, right? And Faisal, if there's anything you want to add to that, but I feel like that's a very key point to make.
Yeah, 100%, 100%. I would say, I think this is the line that's gets said often at Sarwa, and the market rewards discipline far more than timing, right? So I think that's a key. You can say that's a key to everything, not just investing, but yeah, 100%.
Yeah, for sure. So I actually wanted to move because we've actually also got a couple of questions in the chat about Sarwa Invest. So I'm glad that we have this slide also.
Yeah.
And yeah, so turning to Sarwa Invest, and look, Sarwa Invest, for those of you who don't know, these are our managed investment solutions, are sort of passive portfolios that are anchored in modern portfolio theory, right? So very simply, what we do is we have pre-designed investment portfolios that track the global markets, right? They track the foreign developed markets, the emerging markets, the US markets. We've got some fixed income in there. We've got some real estate investment trusts in there. So fully globally diversified, covers all the major asset classes, all the major geographies, all the major sectors. Clients invest money into those accounts, let it grow over time. All the dividend reinvesting is done automatically, rebalancing is done automatically. And most importantly, these are passive and they track the global markets, not just individual sectors or geographies or even asset classes for that matter. Um, so how did the Sarwa Invest portfolios perform against the S&P 500 year to date? And quite interesting, even our conservative portfolio. So for context, in the Sarwa Invest, conventional portfolio, there's six different risk levels. Six being on the higher scale of things, one being on the lower scale of things. We have shared risk scale two, which is conservative, four, which is balanced, and six, which is growth, and how they've performed year to date. And you can see, right, the S&P 500 to the date that we've done this on was 6.2%. The Sarwa conservative portfolio, which has the majority actually in fixed income, was 6.53%. The balance was 7.21, and the growth, lights out 11.52%. And what powered that, right? How was this possible? Because in most cases, right, concentration, in the largest companies in the United States has historically performed, fantastic when you're looking at it from a growth perspective. But what actually powered, the Sarwa Invest portfolios to perform, this well against the S&P 500? And as I said, right, the US equities, that's the loudest part of the narrative. Whenever you speak about, stock market allocation or exposure, that's obviously that's what people focus on. And not to say that you should all of a sudden, tilt your portfolio to European approach or an emerging markets approach. The key that the key sort of portfolio strategy and investment philosophy that we prescribe to in Sarwa Invest is a market cap approach. So let's say the US stock market represents 50% of the global economy, which it rightfully does. We allocate, that amount in a non-speculative manner towards the portfolio. So the equity weightage that we have is still high with the S&P 500, but we've also got other markets in there. So in H1, developed markets in Europe and Japan posted good returns, especially in Europe, right? As I said before, 9 to 13% in gains across those markets. This was driven by central bank policy, very favorable valuations. Um, Now, when we're looking at it from a currency perspective, also, right, this has been a key point of topic this year, where the US dollar has
Mm.
depreciated, right? The euro, the yen, they strengthened in value in comparison to the dollar. This enhanced non-USD returns. It's hidden, right? But it is a powerful lift for international allocations. And the third thing is actually fixed income, right? Bonds didn't spike as much as equities. They cushioned the portfolios. Volatility was lower, drawdowns were smaller. And look, the result was notable, right? Smoother curves, fewer shocks, no, firm chasing of performance. They just captured growth more steadily. And look, I think it kind of speaks to the power of balance, constant rebalancing, global scale. This is what supports the compounding effect. But very interesting, to see that these portfolios actually outperform the S&P 500 year to date.
Thanks, actually. That's quite interesting. You think, and Selma asked in the Q&A, I'm jumping the gun here, but Selma asked, about Sarwa Invest, and I'm glad we did add this section because Sarwa Trade was kind of took most of the real estate space here. But yeah, I was really um, interested to see how Sarwa Invest did fare across the same period, right? You would think that a globally diverse portfolio would historically not perform as well as the SP 500, but as we've seen, and for the reasons you mentioned, it did quite well this year to date.
Yeah, exactly.
And bringing it all together, so what can we take away from this, right? So one of the things is that asset selections, as we've seen throughout this webinar, did play a role, right? Tech, crypto, all performed strongly during this period. They did take a significant hit in April, but we've rebounded and surpassed that initial standing. Gold made a all-time high, and a lot of investors, as we saw, flocked to gold, rightfully so, as it's held strong, usually as a hedge when in times of uncertainty. Um, they both, both gold and BTC, I would say, have started to enter the same space and started to be look at seen as more hedges. Although Bitcoin, I would say, is more of an alternative hedge than gold is. Um, and really, clients' activity really are reflective of this, I would say, trend. And looking across, the broader client base, it was really discipline that stood out, as actually mentioned, right? Consistency and discipline really, I would say, took clients the extra mile, and the returns were reflective of that, discipline. Uh, the figure we showed earlier was kind of a broad figure for the overall Sarwa trade client base, but among those that really stood out were, as actually mentioned, the ones that really practiced discipline, consistency in the face of uncertainty, in the face of volatility. They still stuck and held through, these unstable times and stuck to their core plans. Um, these are clients that contributed regularly, stayed invested, avoided kind of reactive decisions, and tended to show more stable outcomes.
Yeah, it's really good to see, and I think, the whole point about this is to show the data, but then also, what are some of the key takeaways that people can take,
Yeah.
from this, and as you rightfully mentioned, there's, these lessons, but then also to kind of go, into the investment habits, that kind of assist with this growth and, the sort of high performance is, the bullet point says even bold bets need structure, right? So, the point we're trying to show is that it's, concentrated but informed bets, right? It's
Yeah.
not about reckless gambling. It's sort of focus, but with foundation, right? Concentration
Mm.
in sectors or stocks with solid business models, right? Exposure to people who are looking at semiconductor, innovation, and pharmaceuticals, or undervalued European exporters. Like, all of these things were meaningful at the time, right? They allowed people to capture this upside. Um, And this blends well for long-term success, right? It's people having a repeatable approach, and depositing during downturns, right? It wasn't just about holding. It was about people capitalizing on the opportunity that they saw during dips, not because of a formula, but understanding that price falls, will happen over time, but the fundamentals remain for those stocks or for those opportunities, and that's when those opportunities actually emerge. So this is a repeatable approach that a lot of traders actually take advantage of, or even investors, is buying good quality assets at downturns or cheaper times. They know that these markets are gonna fluctuate over time. That is part and parcel of investing.
Yeah.
But having a repeatable approach when it comes to this is really what helps. And look, I would say probably the most important when you're looking at market behavior is discipline, more often than timing, holding through turbulence, right? A lot of the webinar was actually focused on April, right? It brought fear, um, and clients didn't liquidate out of caution, but they gave positions time to recover. And that restraint proved to be very beneficial when you look at your portfolio today, right? It's kind of the essence, it's like, the crux of good investment behavior, right? It's not about predicting, the top stocks, or kind of timing exactly when they're going to go up or down. It's how you behave when that ends up happening. And I think, this combined behavior with a good investment framework is, when markets actually test you during that time, that's when you're going to be rewarded the most. So that's really what we wanted to obviously highlight, right? The information that we've shared is real client data, you know, real information, our portfolio data, and how you can kind of go away with some of these lessons. But I think we're hitting up the time to probably go onto the Q&A section. So I'm gonna move over to that now.
You've already got a few questions. Please keep them coming in. If you have anything that you wanted to ask, let us know. Just one point on your last takeaway, Akshay. And I don't know if this is like the times are different, the clients are different, but I would say specifically during April when markets were volatile, people didn't panic as much as past, I would say down cycles. I don't know if it was just unique to this particular downside, or where I know people are just more attuned to their objectives, and they held strong, they were more resilient. But I would say overall, the majority of our client base held strong, and as the data showed, they actually capitalized on that downturn as opposed to stopped or worst case sold and left their positions. But overall, I would say this time around, this volatile period, although quite significant, but and short lived, but clients still stood, in the face of that volatility and persisted.
Yeah, look, 100%. And I'm thinking back to some of the more volatile market times that we've had in the last decade, right? COVID 2020 comes to mind straight away. 2022 was a pretty rough year for markets, right? We didn't necessarily have one volatile spike.
Yeah,
We just had a
true.
prolonged year of kind of decimation in the markets. I know
Yeah,
that, in 2024, last August, there was, a little bit of a tumble. And then obviously this period, we look back at all of those times, and we've been working together, 3 out of those 4. And you think back at 2022, and the conversations I think that we were having with clients was very different to what we were
yeah,
experiencing this time around. And I guess that's a bit of an insight also to the people on the webinar today, where the conversation was more focused on, okay, this is what volatility is. This is, the obviously the disadvantages that you have if you sell, so and so forth. Like, I think this time around, people, they get it,
yeah,
and it's very
yeah,
clear that they
absolutely.
get it. And it's very clear that the behavior that the Sarwa trade clients have is very different to the average retail investor, because there's a reason why stocks are plummeting. It's because of global sell-offs that also happen from retail investors. We did a webinar during that April time with Andrew Hallam to talk about volatility, and he clearly stated this is the reason why markets are going down, because of sales. And that wasn't actually the case with our
Yeah,
clients, where we saw deposit spikes as opposed to it. So
right.
it's awesome to be an anomaly, when we obviously have these conversations. But yeah, no, I'm glad that you brought that up, because the conversations have definitely changed, since
Yeah,
then, since we've been doing this.
absolutely. Should we open it up for
Yes, let's do it.
questions? Cool. We've got our first question from Rui. Uh, Apologies if I'm not pronouncing your name properly. And he asked, could Sarwa provide a functionality for each investor to compare his her own performance against the S&P 500 or other index? I would say with regards to this, you have tools already available on your app or dashboard where you can, extract your statements or activity statements, or even just by looking at your historical performance chart. And compare it from there. If you needed help with that or wanted more clarity, reach out to us on WhatsApp or email. We'll be happy to provide more context on this.
Yeah, that's awesome. And also like we are this is public knowledge, so I'll share it, but we are going to be launching Sarwa Trade on desktop hopefully this year. So we're hoping that at that point in time there might be something associated with that where you can kind of compare some benchmarks to your existing portfolio. But regardless, we'll definitely share it with our product team.
Thank you for that question. Fahmi actually asked, that was one of Fahmi's questions, after any sneak peek as to what Sero is doing next in terms of
Oh,
updates and features. And that is, yeah, I would say that is the most sought feature is the Sero trade on the web. So that's
I,
coming
j- I
soon, Fahmi.
I I jumped the gun, but Vahmi, also one thing that you could do is if you can reach out to our team also, but if you go onto Sarwa's YouTube page, you can go into the videos, and we actually held an investor day a couple of months ago, and it was held by our senior leadership team, all of our founders, and they, gave a bit of a roadmap in terms of what we've gone through and then what to expect in the future. So there's some interesting things, and as Faisal said, and as I mentioned too, Sarwa Trade on the desktop is a big one. But please have a look at that. If you can't find it, reach out to our team. We'll be happy to share it with you.
Also, another question from Fahmi is, does the data take into consideration fees and charges specifically for Sero Invest?
Yeah, so actually it does. Usually what we do for our data, for anything Sarwa Invest, we use a default management fee of 0.5% per year. So it's net of fees actually. So you'll see that on our website when you look at historical performance. And also this data for the Sarwa Invest portfolios are pulled from Morningstar. And we actually do have, a deduction for the management fee, which is 0.5% per year on this assumption. Obviously, I'm mindful that the price ranges obviously range from 0.4% to 0.85%, but we use 0.5% as the fee. Okay.
Thanks, Akshay.
Let's see. Salma's asked, can you give us the too long don't read for the numbers for Sarwa and Beth? Okay, amazing. I think we've answered that already. But
Yep.
in case you want another sneak peek, this is what we were looking at year to date.
Also, similar to this, Fahmi is asking, with regards to Sarwa Invest halal portfolios, um, if you're curious about the returns for that, Fahmi, you can find them on our website under the Invest tab. You'll find it under historical performance. If you wanted additional, info on that, reach out to us. We'll be happy to provide more information.
Yeah, and then I think also, Fahmi, in terms of the Sarwa Invest Halal portfolios, you also have the ability on the desktop dashboard for your invest portfolio. You can kind of project also what the expected type of return. You can then kind of do a model situation to see which risk profile you're in and how that will kind of hopefully look in the future. But then yeah, as Faisal rightfully mentioned, we've got all of that information too, on the website. Sneak peek, the Sarwa Invest Halal portfolios, the 7 out of 7 risk level is 100% equity allocation. So as a result of that, it has actually performed quite well. I don't have the exact figure off the top of my head, but it did perform quite well, year to date. So you can look at that on the website. So we have a question here from Anil who has asked, what's your criteria to define overconcentration? And it's a really good question, right, Anil? Because
Mm,
at the end of the day, the criteria that we define it will be very different to what somebody else might define it too. Usually, overconcentration it can come in a lot of different forms, right? You could technically have one individual stock and that could be overconcentrated. At the same time, you could also have potentially 10 different stocks, but they're in the exact same sector, right? They are maybe technology companies, high capitalization. They perform in a very similar sort of activity as what the other ones might be doing. look, that is not as concentrated as having one individual stock, but a lot of people would argue that that is overconcentration. Um, I don't know what I would recommend doing is, and feel free to reach out to our team as well. But if you need any assistance with kind of defining that in your own portfolio, reach out to us and we'd be happy to help, take a look at that in some more detail. I would look at different things, right? Look at the investment style of the companies. Are they growth? Are they value? Are they a blend of both of them? What type of sectors are they covering? Is it financials? Is it technology? Is it consumer staples? What's the actual capitalization of the type of company? Is it micro cap, small cap, mid cap, mega cap? Like you want a dream scenario is having a little bit of everything, right? That is the most diversified approach to take. But at the end of the day, if you have high convictions about certain asset classes or types of investments, you can always go that route. So it's going to depending on what your comfort with risk is. But feel free to reach out to the team, and we'd be happy to help with that.
Thanks, Akshay. We have an interesting question here from Krisha, who asks, do we are we going to go through de-dollarization? If yes, then how do we manage our investments in USD bonds and stocks? I think this is coming up a lot, especially as you mentioned, actually, with the dollar kind of going down. This has been kind of a hot topic, I would say, amongst clients. And I'm curious as to what your take is on this, but the way I usually approach this is that, yeah, let's say the dollar does lose strength and value, but the global economy is so entrenched with the dollar that it would take decades, if not more, for let's say for another asset to then, or another, sorry, currency to then surpass or take the place of the dollar. So I would say even if that statement holds true, it would take so much time and so much effort for the global economy to move away and de-dollarize, so to speak, and shift to an alternative. It's a very extra long-term process, I would say, for that to fully happen in front of our eyes.
Yeah, look, I agree 100%. It's something that look, we've seen it happen, but it's super gradual and I would say very limited in scope. There was conversations, right, with everything that was going on in US and China and Russian sanctions. China and Russia, they diversified away from sort of dollar reserves
Yeah,
and
yeah,
dollar trade settlements. I know there was also conversations about South Africa doing a similar thing. There's bilateral trade agreements now that are non-USD. China and Brazil, for example, that's the thing. India and Russia, those are not in US dollars. Historically, that always used to be a thing. But US dollars, I want to say, constitutes, I mean, just off the top of my head, probably over 85% of transactions. You think about the region we're in right now, the UAE, the dirham is pegged to
yeah,
the dollar, right? It's still the
yeah,
preferred currency of global trade. Debt issuance is also, you see foreign governments that issue their debt in US dollars. And at the moment, there's not really a clear alternative with that level of depth, that level of liquidity. And at the end of the day, that level of rule of law, like there's a lot of systems and infrastructure that's backing it. Now, how
yeah,
it would sort of impact investments, right? Um, I think things like US bonds, right, they would still be considered safe regardless of currency risks. And US companies, once again, right, they have global revenue, right? A lot of these S&P 500 firms, they earn a significant amount of non-USD income, which actually already acts as a hedge in your portfolio. A lot
yeah,
of people shift to things like gold, right, in these times because of they don't want to deal with sort of currency fluctuations or anything like that. But at the end of the day, I don't think it's a serious cause for concern. We've had this conversation a lot, over the last few decades. This topic does come up quite often every time that the US dollar has devalued, similar in a way that, you have the conversation about, look, is the stock market the best vehicle to invest in when there's times of volatility? And then, time and time again, it has rebounded. But it's a great thing to be mindful of, I will say.
We have a question from
Okay.
Anonymous. I like these questions. Basically, Anonymous is asking, they're new to this. Is it possible to start with 200 AED? And the short answer is yes, depending on the product you want to use. But really, we have really low minimums across the board. In fact, on trade, the minimum amount you can trade is $1. So you can kind of test it out with that little of an amount. So yes, Anonymous, you can, start with 200 AED to answer your question.
Yeah, that's I love that question too. It's awesome to actually get started. Um, so we got a question from Mohammed who's asking what portfolio is that, the 11.52% return?
Mm,
And then so Mohammed, so that portfolio that we've basically indicated, that is the Sarwa Invest conventional portfolio, which is 6 out of 6 on the risk scale. I think you
hmm
referenced the 7 out of 7. The 7 out of 7 is the halal portfolio for Sarwa Invest. So that's basically the Sharia compliant investment portfolio where you have, the ability to invest in 100% equity exposure um, in a Sharia compliant investment portfolio. Faisal and I actually did a webinar recently on, Sarwa, not necessarily Sarwa specific, but halal investing. So if you are interested in that also, you can go over to the YouTube channel and take a look at that for some more details on it. But the portfolio that we've indicated on the slides is a 6 out of 6 conventional Sarwa invest portfolio. Okay. I think we've got a question from Mohammed who's asking about stock pricing lag compared to Yahoo and MSN. Could you advise what the data refresh rate is? And for Sarwa Invest, how the updates are performed. Okay, so Sarwa Invest, we use end of day pricing data. It's typically updated once per trading day, after the market's closed. So the way it works is, the platform it's in the United States. So trading in the United States is Monday to Friday. In the UAE, the way that the dashboard will update is usually around 10 a.m. Every day from Tuesday morning to Saturday morning is when you'll see it. Um, so that's basically how it works for Sarwa Invest. Now, prices on the platform might not match, external sources. We get the pricing data live from our broker on Sarwa Trade, which is Alpaca Markets, and they feed directly into the US exchanges. So basically, whether that's NASDAQ or whether it's the New York Stock Exchange, and it's aligned, very much with what's actually happening specifically with live data. So for crypto, it actually refreshes, constantly. The crypto market is 24/7. And with Sarwa Trade for equities as well as ETFs, we've got pre-trading and some post-trading hours, and then obviously live trading. So it's ranges from US market hour times, usually 9:30 a.m. To 4:30 p.m. with a couple of hours here and there, with post and pre-trading as well.
Thanks, Akshay. We've got our last question just on time as well. It's not a question, actually. It's from Fahmi. He's on that's very sweet of you. Shukran, Fahmi, for these nice words. Just stating that he enjoyed the webinar and he uh, you know is enjoying his experience so far. Thank you for joining, Fahmi. Really appreciate it. You had great questions as well. So thank you for those.
Yeah, I think that's a very nice way to end the webinar. Right on time, and we've
Yeah,
answered all the questions with a very nice and warm comment from Fahmi. So thank you everybody for joining today. Look, we really hope that you gain something valuable out of this. As we mentioned, right, the purpose of this was to provide you with some insights and hopefully, get some good takeaways. If anybody has any questions or wants to dive in a little bit deeper, please don't hesitate to reach out to our team. We're obviously more than happy to help or to clarify anything. Faisal, as usual, it's been a pleasure to do this with you. And yeah, until next time, everybody, thank you so much.
thanks, Akshay. Thank you so much, everyone, for joining. It was a pleasure. And yeah, you should be receiving a recording of the webinar tomorrow as well. So yeah, and if you need anything at all, don't hesitate to reach out.
Awesome. Thank you, everybody. Good evening.
Bye bye.